Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Chris Englebert, Founding Partner and Chief Investment Officer at Englebert Financial Advisors, to discuss how RIAs should approach the discussion of debt with clients. Chris, it's great to see you as always. Welcome back to Trade Talks. And before we get into the debt conversation, what is top of mind for retail investors right now?
Well, right now, retail investors are really struggling. And not really struggling, but they keep asking us the question because they many of them refinanced their homes in the last couple of years at these ultra low mortgage rates. And as clients get older and get closer to retirement, they have this overwhelming urge to pay off their house. And I can't tell you, we must have had a dozen conversations in the last couple of months where clients are like, hey, I just refinanced my mortgage. And I'm like, okay, that's great. What rate did you get? Oh, I got 2 3/4. I got 3%. I'm like, great. You're never going to pay off that mortgage because that is really an ultra low rate in the history of mortgage rates. And a lot of clients have this overwhelming urge to try to be debt free, but we're like, you got to understand that's actually good debt versus bad debt.
And on the flip side, there is bad debt. And a lot of the times that amounts to open credit card balances.
Yeah, for some reason, a lot of younger people, believe that, hey, if I have multiple credit cards open, I have little balances on each credit card, I'm building my credit history. And that's not the case. If you have multiple credit card balances open, it does give you some credit history. But what we've really seen happen is we've seen people get what I call credit card creep. They're not paying attention. They make the minimum payments. And the interest rates on these credit cards are literally 24%. I'll never forget one time I had a woman come in and she had a bonus. She was very happy and she was all excited to invest her bonus. And I said to her, well, what's your credit card situation? She's like, oh, you're not going to like this. I have $20,000 on one credit card. I'm like, well, why aren't you paying that off? Well, I just can't stand writing that check. And I said, well, this is the only time you're going to hear me use the word guaranteed return. But I said, if you take your bonus and pay off that credit card balance, you're going to get a 24% guaranteed return because you're wiping out that high interest rate. And so some people just can't bring themselves to do that. And what happens, like I said, with this credit card debt creep is their credit card balances get higher and higher and higher. And you really have to have the candid conversation with them and say, listen, by doing what you're doing, you're not able to put money into an IRA. You're not able to put money into your 401k or 457. So you're really, straining yourself in other areas when if you just would focus and concentrate and use credit cards properly, you could end up having a better financial future.
Yeah, this whole conversation always gives me agita. I just can't imagine snowballing, which does happen sometimes when you're in your 20s, you get out of college, you're making some money, you want to do fun things with your friends, clothes, go out to dinner and all that. And it does snowball so quick. I mean, this is a great conversation that we could have even in April for Financial Literacy Month. But Chris, I think another important thing to remember too, especially in your 30s and 40s, it's not just credit card debt. That's typically when you're either buying a home, you have to pay for kids, you're saving for college. There's so much demands on the income stream.
Yeah, and we see this all the time. And so, people come into us, we do a strategic financial plan for them. And a lot of times people get, hyper focused on one area. Like, hey, I got to save for my kids' college education. Hey, I got to put money in my 401k. And I say, I understand that, the strains that, you're spending money in different areas, but what you got to do is just do a little bit. Just make sure you're keeping up with your 401k. Make sure if your 401k has a match that you're at least putting in the amount for the match. If you're starting a 529 plan for your child, hey, $50 a month, $100 a month, just try to do something in all areas. And pretty soon what happens is after you've gone through those big expenses and expenditures, all of a sudden you can sit back and go, whoa, wait a minute. I can afford to put $100 more or $200 more. So, I hate to say it's almost like you have to do everything, but you got to pay attention and at least do a little bit in every bucket so that 10 years, 15 years from now, your buckets are growing and you actually have money.
Especially if it's automated out of your paycheck, you don't even think about it. I don't even know how much goes in. I mean, I know the percent, but the dollar amount, it doesn't even factored into what I think about, when I get my paycheck. Let's talk about the charts here for a moment because February, let's call it the February flip in the S&P 500. That's for sure, Chris.
Yeah, I mean, the S&P 500 rocketed out of the box. We're up almost 7% for the year. February, we saw the narrative change. I mean, interest rates went up. The 10-year Treasury touched over 4%. That proceeded to sell off in the stock market. But here at the beginning of March, we're actually seeing a bounce off some very important technical indicators, the 200-day moving average. And again, the narrative is beginning to change a little bit as we get more economic data. I follow a lot of good economists out there. One of them I want to give a shout out to, Brian Westbury from First Trust. Brian Westbury says, with what's been going on the last 3 years, looking at the economic data is extremely difficult to do. I mean, we shut down the economy, we opened it up. The service side of the employment sector seems to be rebounding. The manufacturing side is slowing down a little bit. But again, we're in a very difficult period of time as far as economic indicators and able to get a real beat on the economy. And that's what the U.S. stock market's kind of struggling with. When we see indicators of the economy slowing down and earnings coming down, stocks start to sell off. But then when we see interest rates, reverse, and all of a sudden it looks like the Fed's going to pivot, we see a stock market rally.
Right. Well, I mean, Chris, the fact of the matter is too, there is no one on any corporate management team, no one in the advisory business, no one on the sell side or buy side who has ever lived through a pandemic. The last one was 100 years ago. So right. Trying to anticipate what that looks like in today's market environment, it's a new roadmap for all of us. And I think, that lends to some of the uncertainty. Let's talk about Nasdaq. Tech led the way with the COVID recovery, also led it on the way down. It looks like it got into some favor in January.
Yeah, we identified in December that many of these high-tech stocks had really been slammed. I mean, you had market pundits saying that earnings were going to drop off the cliff. And here we are in ending up the fourth quarter earnings season. And this week, you've had some major tech stocks report some really good earnings. It's becoming much more company specific, which we think it needs to. But again, we're seeing kind of a regression to the mean where something like large cap tech got extremely under-owned in December, and now it's offering a value. And guess what? The Nasdaq led on the way down last year. It's leading on the way up this year.
How about the small caps, Chris? Is now a good setup for them? They typically do well in an economic recovery. Once that recovery cycle starts, or we get, the economy is doing well now, but is it a good early setup? Should we recover or don't even have a recession?
Yeah, exactly. And this is my favorite asset class. I've talked about this the last year and a half. We've been a big fan. The Russell 2000 is the second best performing index so far this year. Unfortunately, the Dow Jones Industrial Average is the worst. But again, small mid-cap stocks can benefit. They can raise prices faster. They can pivot. And again, I'm very surprised at the lack of M&A activity. There's been some M&A activity in the biotech space, but I think you're going to see some more M&A activity in the small mid-cap space. Once corporate America understands what their costs of funds are, they're going to come back and say, hey, listen, these companies are cheap versus their growth rate, and we got to buy them. So I'm expecting a lot more M&A activity in the next 6 to 9 months in the small mid-cap area. And I really think once that heats up, this area could really be a big beneficiary of it.
Chris, it's interesting. The guest before you was bullish on the energy space. That was his pick. And oil's kind of been sideways for quite some time.
Yeah. We made a big call last year. We're extreme bears on oil. You can see it trading kind of sideways in a range right here. I do a lot of work with volatility, and anytime, doesn't matter if it's a stock, an ETF, an asset class, a commodity, anytime you have tremendous amount of volatility in a particular area, especially like a commodity, it tends to revert down to having a very low volatility setup. And that's what's happening right here, is that we've had a very tight trading range in oil. And I think that continues for most of the year. I mean, it looks like, as simple as it sounds, the supply and demand of oil is extremely balanced at this point in time. And if that's the case, you could have a big go nowhere, as far as oil goes. But that doesn't mean that the oil stocks can't do well. I mean, a lot of people make the mistake that, the oil companies can't make money if the price of oil is low. That's not the case. And in fact, the oil companies are still the number one performing area as far as earnings go so far for 2023.
And finally, let's wrap with the 10-year, of course, the 10-year being the proxy for what's happening with macro.
Yeah, I mean, we ended up the year at 388 on the 10-year. We then began to see yields float back down. And then most recently with some hot CPI and PCE numbers as far as inflation data, we zoomed right back up. Everybody's looking at the specter of, oh, the Fed's going to have to raise again. Do they do another quarter, another quarter, another quarter? We don't really know that. But again, our view on interest rates this year is that they become pretty sanguine. I mean, again, going back to volatility, we had a huge volatile year last year in the interest rate market. And my view is still that we're plus or minus 50 basis points on the 10-year, right around 3.5%. So we were at the bottom in the range, right around 3 3/4. We've traded to the top of the range, a couple of ticks over 4%. Again, I think that range is going to kind of be where interest rates, at least on the long end, trade for 2023.
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.